doesn't seem so low. Doesn't seem so far away. Doesn't seem so. Doesn't seem so far away.
Hello and welcome to Looking at the Markets with David Modell. I wanted to explain very briefly support and resistance and how sometimes support becomes resistance and vice versa. Before I get started, I'm going to put my email address on the screen for you, because if you want some help with your trading or investing, or you want help putting together a trading or investing plan, because you really should have a plan if you want to be successful at it in the long term, then you can email me for coaching. If you want the coaching, email me at davidmodell@gmail.com. So let's talk about support and resistance. Well, let's go back a little bit. First, we're going to talk about swing low and swing high. These are candlesticks, so this is a candlestick chart. But you can do this with a line chart or any kind of, practically almost any kind of chart, really. First, to understand support and resistance, you have to realize that oftentimes in a price chart for stocks or whatever it is, the price will go down and then it'll come back up. But when it goes down, that's called a swing low. Okay, and then it comes back up. And then it'll come back up, and oftentimes it'll come back up to a certain point and then start to come back down. And that's called a swing high. Okay, so you've got a swing low and a swing high. And then, you know, a lot of different swing lows, swing highs. All right. And so there's a series of them. And they keep happening in stocks and currencies, whatever it is. So in your mind or on your chart, you can oftentimes connect the swing lows. And sometimes they even come down to exactly the same price or pretty close to it. It's not often that it's going to come down to exactly the same price. It's not an exact science, usually. But if it comes close to the same price, then you can start to connect those points with a straight line, okay? And so when you can connect the swing lows, especially if you can connect at least 2 or better yet 3, 4 or more of them, because the more the better, and I'll talk about that in a moment, that's called a support line. When you can connect them with, like this line here, that's called a support line. When you can connect them with a straight line, connecting the swing lows. What about the swing highs? Well, there aren't as many here that you can connect, but that's okay. As long as you have at least 2, you can connect the swing highs. And in this case, I'm including the wicks, you know, these lines at the bottoms of these candlesticks on the chart. Some people do not include the wicks. That's okay. You can only include the bodies when you connect them. But here we are connecting the wicks. And the wicks here. And when you connect the swing highs, at least 2 of them, then that's called a resistance line, when you draw a straight line between them. All right? And you can extend beyond the points, as you can see. You don't have to start at the points and end at them. You can extend the line as far as you like in both directions. Why? Because you want to remember that price, that level in the future, in case it comes up to the resistance line, and you might start thinking, uh-oh, it's back up to that same line where there was resistance before. Resistance? Well, yeah, think about it. The traders, the trading community, faced resistance in trying to bring it up past that line here twice. Okay? And so if the price got up there again, you might think, uh-oh, the buyers might face resistance from the sellers yet again. And so you might think, I might not want to buy up here at this line, or if you own the stock or whatever it is already, you may think, oh, maybe I should take profits. Maybe it's time to sell. Maybe it'll start coming down. There's no guarantee that that will happen. You're just playing the probabilities. You're using historical data to make a judgment for yourself. And when the price has come down to a certain level, then in the future you can draw the line indefinitely into the future as far as you want, because if the price comes down to that level again, you might think, there's support there. There was support before, and the more times the better, right? Because that gives you more confidence that if the price comes down to that support level again, then almost like a floorboard, okay, the buyers will hold it there. They will not let it go below, hopefully. Again, there's no guarantee. We're just looking at probabilities and history here. And perhaps that might be a place to buy, because you're thinking, well, it's been down to that level and bounced off of it in the past. Maybe it'll come back up off of it again. All right. Now, it's really not like a hardwood floorboard, because it could come down and crash below it at any time. So there are no guarantees here that support or resistance will work. To me, at least in my opinion, the more times it comes down to that line, psychologically at least, the more confident I am that if it comes down to that same level again, that same line, that it'll probably bounce off of it. It'll be at least more probable, because the trading community, the investors, have demonstrated more times, in this case 1, we can count this as number 2, 3, 4, at least 4 times, that it's not willing to, the traders are not willing to take it below that level. This resistance line is a little bit less strong, at least psychologically to me, because it's only demonstrated once, twice, that it will not go above that line. All right, so that's a little bit less strong of a resistance line, as opposed to this support line, which has 1, 2, we'll count this as 4 data points. That's what I call them, data points. This line here, this resistance line, only has 1, 2 data points. All right. And by the way, they don't always have to be perfectly flat or horizontal trend lines here. And by trend lines, I mean the support and resistance lines, okay? They could be tilted upwards, or in this case, downwards. That's right, you can connect the swing lows. Here are 2 of them. 1, 2. You can connect them even if they're going downwards. You can still call that support. Now, some people define the words support and resistance to mean only when they're perfectly horizontal or very close to it. That's a stricter, narrower definition of support and resistance. Okay. If you want to define it that way, that's fine. My definition of support and resistance is a little bit more broad. To me, I would include slanted or tilted lines. They don't have to be perfectly horizontal. So here are 1, 2 swing lows where I can connect the swing lows here. So it's not super strong, only 2 data points here. But still, that could be considered a support level. And so if the price comes down to it, maybe it'll bounce off of it. It's done it twice before. This one is a resistance level. And I'm going to count this one. Did it reach it exactly? No, but it's pretty close, and this is not an exact science. So I'm going to count this as 1. I'm not counting this one. Not quite, not close enough, but I'm going to count 1, 2, 3 data points. So a little bit stronger to me than this one, which only has 2 data points that I see. And that's resistance, because we got a swing high, then it came down, swing high, came down, swing high, came down again from that same line. And I drew it out into the future because I want to be aware of where it is, because maybe if it gets up to it again, that might be something to watch out for. Maybe time to take profits or sell if it gets back up there again, possibly. No guarantees. It could always break through this line, or it could always break down below this line. Okay? So these are not ironclad, perfect, guaranteed at all. All right? So let's look at some real-life examples here in a moment. But just, to me, again, psychologically at least, the more data points you can connect, the stronger the lines are, at least to me. Okay. Also, I'm looking for recency. I'm looking for them to be recent. All right. So if I'm connecting data points that happened a long time ago, those data points to me seem a little bit less strong because they're a long time ago. Whereas if they're more recent, like notice that the ones we're connecting here, they're pretty recent. They're not way back here on the chart. They're not way on the left, okay? So if all the data points that you're connecting happened a long time ago, they're way, way to the left of the chart, that might not be convincing, all right? As opposed to more recent ones on the right half of the chart, let's say, or the right side of the chart, yeah, that could seem a little stronger. So you want them more, more data points, good, stronger, and the more recent they are, I think the better, okay? So let's look at some real-life examples, and these are daily candlestick charts. This is from finviz.com, and this is Boeing stock. But it doesn't really matter what the stock is. We're just looking at the lines as examples for this, okay? And so here is a support type of trend line. Only 2 data points, but they are recent. So that seems to work in its favor, the fact that they're all the way to the right side of the chart here. This one, so this is a support line, and it's tilted upwards. This is a resistance line. It's tilted downwards, as you can see, and it has, we're going to say 1, 2, 3 data points. So that seems to be a little stronger than this one, or is it? Because these are further back in time. I mean, like this data point was a long time ago. This was months and months ago, and this one also. Okay, so these data points are further back in time, but there are more of them. This one only has 2 data points, but they're pretty recent. So which one's stronger? Well, I'll let you decide, okay? You have to make judgment calls sometimes. All right, let's look at NIO as another example. Here's an example where, do we have a horizontal trend line, a resistance line here? I suppose so, because it came up to approximately this level, a little bit higher, and then almost came up to that level again of what looks like $5.25. Not a super strong resistance line here, only 2 data points. Also the exactness, that's another factor you can consider. I mean, it really went, if you include the wick, it kind of went quite a bit above this resistance line, and then it didn't even really touch it here. So the preciseness is a factor, and so because there are only 2 data points and they're not super recent, and also because they didn't touch it very precisely at all, I would say this horizontal support line, resistance line is it's not super strong at all to me. I would not put a lot of weight into this and wouldn't give it a lot of consideration. What about this one? This one that's tilted downwards. Well, it seems a little bit more precise at least. Still only 2 data points. Not extremely strong either, but at least it's more exact. Then here's a much stronger one, this support line here. Okay, it's tilting upwards. 1, 2, 3, 4 data points. I like that. Okay. Also, yeah, you have a couple that are a long time ago, but you have a couple of recent ones, so that's good. And they seem to be hitting it pretty precisely here. Definitely precisely here and here. And you have the wicks going below, but the bodies of the candles are clinging pretty closely to this line here. So that's a pretty strong support line. I would take that into consideration if it were me. If I were trading NIO stock, if it came back up to that line, I would just keep drawing this line, okay, into the future, but not forever into the future. If enough time passes and this line just keeps going and going and going without any more data points for a long time, day after day, month after month, let's say, on this daily candlestick chart, then I'd start to think, oh, this support line is starting to lose its importance, starting to lose its strength if enough time passes and it does not touch it again. Okay. Here's another one, AKR, and check it out. You have a fairly strong horizontal, happens to be, support line here at the $10 level, let's say. Came down to it very precisely 1, 2, 3 times, 3 data points, better than 2. and it has that precision there, the exactness, and they're very recent. So to me, that's pretty compelling. That's pretty powerful. If it comes down to 10 again, I might actually consider buying it, for example. But you have to make your own decisions. You know, don't just buy something only because it came down to a certain level. Even if it's a strong level in your opinion, you still want to make sure it's a great, great stock, great company, that kind of thing. You can confirm it with your own research for sure. You're not just buying something because it touched a line. All right, that's not the idea. It's just to give you ideas. And so this is pretty strong. And when you get a stock or whatever it is, when you get the price coming down to a horizontal, a flat support line, 1, 2, 3 times, you can call that a triple bottom pattern or a multiple bottom pattern. If it came down only twice, that would be a double bottom pattern, let's say. And by the way, if there's a perfectly flat or horizontal, not perfectly, but flat or horizontal resistance line, and the price did a swing high, came up to it once, twice, that would be a double top. If it came up to it 1, 2, 3 times, and then came back down, that would be a triple top or multiple top. All right, so just to give you some terminology there. Now, sometimes a support line becomes resistance, and a resistance line can become a support line. Yeah, they can actually reverse roles. Isn't that interesting? All right. And this usually refers to horizontal or flat trend lines. Not necessarily, but oftentimes this is how people refer to support becoming resistance and vice versa. All right. But it doesn't have to be horizontal. So you have a price, doing a swing low, coming down to that same level, so you call it support, comes down to it again, but breaks down through it. Okay, so now it comes back up to that same point, a swing high, and then falls down. Notice it's resistance now. Okay, it's experiencing resistance now. Cannot get above that line, that same line that it didn't want to go below it before. So that's support becoming resistance. Or you could have resistance where it comes up to a certain level, then falls down, another swing high, another attempt to break through resistance. It fails, goes down, so it's resistance now. Then it comes up again to that resistance line, but then goes way above it, and then comes back down to that line and bounces off of it. Now it's support. Same line that was resistance. Same level that was resistance before. Okay. Here's another chart showing what that might look like. Okay. You might have a support level coming up, a resistance trend line coming down. So you're forming what might be called a symmetrical triangle here. All right. Just so you know the terminology. But perhaps the price breaks out of the triangle to the upside, goes above it. Okay, before this line was resistance. It kept coming up to it, swing high, and it fails. Swing high, fails. Swing high, fails. Swing high to that same resistance trend line, then breaks above it, comes back down to meet that trend line again, bounces off of it. So now, and that's the retest. It's retesting that line to see if it really is in fact support now. And yes, bounced off of it, now it's support, okay? And it goes up and up. Doesn't always happen like that, but that's a chart showing what might happen, and here's a real-life example of that, okay? We have a lot going on here, but we're just going to focus on this horizontal trend line here at the 90-cent level for MARA stock. Daily candlestick chart, okay? Bounced off of it once, with a swing low. Bounced off of it again. A little sloppy here, not perfect, but it did come back up above it. Didn't go far below it, so we'll consider this. And actually, there's another data point here with the long wick of this candle. So we have 1, 2, 3 data points, 4, 5. That's pretty strong, okay? And at this point in time, they were all recent as well. Came back down to it again. You might have thought about buying it. It clung to it for a while and then failed. Uh-oh, broke down, right? Came back up here, in that day, yeah, the wick went above it, but by the end of the day, it closed below it and then fell down. So now that former support level, formerly pretty strong support level, after it broke down below it, tried to come up with a swing high, failed, came back up, tried to do it again, failed, came back up again, failed, 3 times in a row. This is definitely now not support anymore. Now it is resistance. Formerly support, now resistance. And so if it comes back up to it again, might be a time to take profits or sell. So there you go. That's my simple explanation of support and resistance. And I encourage you to keep doing more research on your own. And if you would like some help, if you'd like some coaching, and you want some help with support, resistance, that kind of thing, or putting together a trading or investing plan, you can email me for coaching at davidmodell@gmail.com. It's on your screen right now. I want to thank you so much for watching and listening to this video. I will talk to you again soon.